documentation that everybody in this room is going to be looking at. In the meantime, I'm going to pass around a sign-in sheet so that we can keep track of who's here. And then on the phone, if you guys have any audio problems at all, if you text Randy so that we can know what's going on. So probably one of the big questions is, why are we all here today? And the reason that we're all here is because construction lending is a whole different animal. For those of you who have done it in the past, you understand that it's not like originating a purchase or a refinance. There's a whole nother aspect of it, because you got to start out with a piece of dirt and you got to end up with a house on it that we made a loan on. So there's a lot of moving pieces. So in order to be able to originate those, we decided internally that we want everybody to go through a training session. Some of it is the fact that you're willing to come spend an hour and a half today tells me that you're serious about doing construction loans, because what we don't want is the person who does one construction loan in their career, and because what you end up with then is you end up with an angry builder, an angry borrower, and probably an angry sales manager because you screwed up the deal because you didn't know what you were doing. So that's why we're all here today. Just show of hands, who in here has done a construction loan in the past? Who's done a one-time close? Who's done a two-time close? Okay, so we have some people in here that have done this before, and if you haven't, hopefully you looked around and saw who was raising their hand, because you can always go to your sales manager, but there's also other resources of people that, if we're not available and you have a quick question, you could ask them what's going on. Today we're presenting two different types of loans. We're presenting what's called a two-time close construction loan and a one-time close construction loan. And I'm going to spend some time talking to you about the two-time close, which we do through Alliance Bank. And I think a number of people in here have done this already in the past. Who has closed something with Alliance Bank so far? Got one at Docs. Anybody else? Okay, so we really haven't done a ton of this. And then at about 10:30, we have a couple people coming in from Washington Federal to tell you about the one-time close product. But before we start into it, I just want to give you guys the basic 101 construction lending on what the difference between the two is. A two-time close involves a construction lender, which is typically a bank, that does not want to get in the business of originating residential mortgages. And the reason that they want to do a two-time close is if they do a construction-only loan, it doesn't fall under some of the compliance and regulatory guidelines that they have to meet if they're doing a one-time close, because a one-time close is considered a consumer loan. A two-time close, where they just do the construction loan, is considered a commercial loan. So there's a lot less regulatory issues that they have to deal with. So a bank like Alliance that doesn't do residential mortgages, they like doing these as long as we can do what's called a takeout loan at the end to take out their construction loan. A one-time close encompasses the construction loan as well as the permanent loan all into one loan. And you'll hear advantages of doing that, but some of the ones that come to mind right now are you lock in your interest rate for the life of your loan right up front. You also don't have to go through a second set of loan documents when everything is complete. It automatically rolls from your construction loan into your permanent loan. I've done a lot of those in the past, and it's a matter of what you decide to sell. The sales side of it that I want to present to you today is a one-time close. You sell it on the fact that they lock in the rate up front, and they don't have to go through this twice. The two-time close, you can sell in a number of different ways also, from the standpoint of there are more loan options at the end, rather than on a one-time close, you're really going to only have like a 3-year arm, a 5-year arm. There's very few fixed rates available. But on a two-time close, they can get fairly cheap construction financing and then come in and have you guys do a permanent loan on whatever loan program they want to go with. So which one you sell is up to you, and it's going to kind of depend on your customer. And we'll try to sort that out as the day goes on.
On the two-time close, do you use the same escrow title company or something, the same fees for the client?
You know what, we'll get into
Okay.
to all that. Let's save the questions till the end, because we'll have a million questions if we're asking them along the way. So, like I said, Washington Federal is gonna come in and present on the one-time close, but what I wanna talk to you about is if you're gonna work with Alliance Bank on the two-time close. So what you're gonna find on your chairs when you walked in is the information about the Alliance Bank program. And some of the things that I wanna highlight is on the second page, you're gonna see a matrix of loan to value and pricing. Okay. One thing that you'll notice in there is they give better pricing, better interest rates for larger loans. So Alliance Bank is not wanting to do a $150,000 construction loan on a tiny little house. Their wheelhouse is more the $750,000 and above jumbo custom type homes. So kind of keep that in mind, because if you're looking at, the person who bought a little postage stamp lot and wants to build a $150,000 house, it's probably not a great fit for Alliance Bank. They also, if you look at that, they have a origination fee in there of 1% that's going to be charged on every single loan. So from a pricing standpoint, in the second to the left column, it's going to talk about the interest rate that you would have during construction, and that is an interest-only payment that your client is going to make based on that interest rate and the amount of money that has been dispersed. Okay, so for somebody in here who's done a construction loan, before any money is dispersed, is there any type of payment that the borrower makes? No, because it's only based off money that's been dispersed. So the way payments go during the construction phase is you start out, you may disperse a little bit of money at the beginning to pay off, maybe a small lot loan, but the interest is very small, and then after the first draw, which comes at a certain phase, then your payment goes up a little bit. The next draw, which might come when the roof goes on, goes up, on and on and on, and then at the end of construction, it's almost a full mortgage payment because all that money has been dispersed, but that is when we come in with a takeout loan, okay? And when I say takeout loan, what I'm talking about is any normal refinance, and the refinance is you're paying off the construction loan, okay? Does that all make sense? Any questions on that part before I move on? Okay. The next thing is, with Alliance Bank, they're very specific to the fact that you must have a licensed contractor do the work. So if Randy is building a house and he's not a licensed contractor himself, he needs to have a contract with a licensed general contractor to build this house for him. Okay, so Keith, make a little note there that if we're going to be about 10 minutes. Thanks. Make a note that there must be a licensed contractor involved. Now, if somebody is a licensed contractor and wants to build their own house, you can go ahead and do that. But other than that, there are not owner builders allowed. When Washington Federal comes in and tells you about their product, they're going to go through the draw process. They're also going to go through some things to show you what a cost breakdown looks like, what a description of materials looks like. I'm not going to go through all that. You don't need to hear it twice, but Alliance Bank has all those same forms, and what you're going to find in your packet are those forms that you're going to need if you decide to do an Alliance Bank loan. Okay, does that make sense? One thing that I know that everybody in here is wondering is, how do we get paid on these deals? And there's two ways you can get paid if you're doing a two-time close. One is in that matrix that we looked at, there's a 1% origination fee. That gets split between us and Alliance Bank, so we get 0.5%. It's going to be treated like any brokered loan, so you guys would make half of that, and half of it goes to homeowners. Okay? Will that apply to your tiering? Yes, it will. So if you're doing a construction loan with Alliance Bank, that's going to go into your monthly tiering. The nice thing is, when it's done, when they're done with building the house, then you're going to handle the takeout loan for them, and you're going to get paid like any other loan, okay, that you would do. So it's almost, in some ways, a double dip if you do that, keeping in mind that it's a double dip a year later, because it usually takes about a year to build a house. When you do a loan with Washington Federal, because it's a one-time close, then it's going to be treated like any other brokered loan, where you guys would receive your normal split on a brokered loan file. That will also count towards your tiering. Okay? Does that make sense? Yes.
Just point out too, the other advantage of a two-type close monetarily, I mean, I think everybody thinks the one-time close is superior, and it definitely has its advantages, but you're talking about 0.5% on the construction loan and then a full commission on the perm, because it'll be treated like a total refinance. So if you're on the 165 plan, you have 165. Washington Federal, it's 1%, and that's total origination we have, and then we need to do that to be competitive, and you'll find out why. So there's a financial advantage to doing the dual close too, and I just wanted to point that out.
Yeah, definitely. If you guys can choose and you can sell it, a two-time close to you guys is much better. One-time close, what happens in this market, and very few mortgage bankers do construction lending very well. And part of it is because the banks control the construction lending, because we don't have construction departments that are set up to go do draws, to do inspections. We don't have $20 million sitting around in the bank that we can lend out during these, if you had $20 million construction loans going, you would need a lot of money in the bank to disperse that until you could sell that loan at the end. So banks control this market. So what happens is, if you want to do a one-time close, they don't make it real cheap for us. They would prefer to do those themselves, but they realize that they can also make money by having a wholesale division that brings the deals in. But it's not the most attractive loan, which you're going to hear about later when we talk about pricing on a one-time close. Okay? Let me just look at my notes here, and then we'll open it up to any questions that people have. Oh, as far as if you do a one-time close or a two-time close, you have to have a loan file here, just like any other brokered loan. And there would be some argument that, well, it's a commercial loan, so we really don't have to keep a file here. But we have to protect ourselves, because if we are earning a fee, we have to have a file here that shows that we did enough work to earn that fee. So even if you're essentially pushing everything over to Alliance Bank and they're handling all the paperwork from there, you still have to keep a loan file here with your processor, so that at closing, when the funds get dispersed and we collect our 0.5%, we have a file to put that in and document that we did the work to earn that money. Okay, so keep that in mind. So that's really all that I have on the Alliance Bank program. I really just wanted you to see what the rates are, what the LTVs are. And then after that, the construction process is going to work very similar to what Washington Federal is. Okay, Alan?
Is there a cap on this, like there is on the jumbo loans? Does that apply on construction?
What do you mean? Like, how much you can make?
Yeah.
No, it's always 50% split.
Okay, so it could, so on a $2
So if
million loan.
you did a $10 million construction loan and we earned 0.5% on it, what is that? 50,000, so you make 25,000.
Tim, is it, homeowners is getting 1%, correct?
No.
Homeowners getting a half?
There's 1%, half of it goes to Alliance Bank, half of it goes to us. So you really don't make much at all on the construction loan itself. You have to look at it as, hey, I get paid somewhat, hourly wage on this construction loan. Where I'm really going to get paid is at the end when I do the takeout loan.
Okay.
Jeff?
Especially here, since they'll do stacks, which is amazing. Okay, can we charge more than the 1%?
On a spec? I don't know. I'll ask. I'll write that down.
I mean, because otherwise, you're never going to see a back end deal. And I had one the other day.
I'll find out.
To do it.
Yeah, that's a good point. Something like a
They'll pay.
2%.
They'll pay it.
Yeah, that's what they're used to.
You can give them market rates.
Yeah. One other thing that comes up is, Jeff was talking, I realized I skipped, is we are going to have to provide Alliance Bank what's called a takeout letter, that essentially is a pre-approval from us that Johnny and Susie Smith can qualify for a loan send out a takeout letter on a clean slate loan, because I don't know if that product's gonna be around a year from now. So you gotta have a clean borrower. You can't have somebody that's iffy, because we're promising a bank that we have a very strong relationship with, that we're gonna be able to take out their construction loans. So you're not gonna get us to, support, sending a takeout letter if we're not 100% confident. I mean, anything could happen after, but we're not gonna send out a takeout letter on an iffy borrower. That's really what it comes down to.
To that also, I had a Christmas loan, and Kelly and I worked on getting that takeout letter, so we were in compliance. So where you sent one out, you probably have it. They have one that's done, and it's been sent to the lawyers that our side makes us we're good. So if something falls apart, we're not
Okay.
in the water.
That's a good point. Did everybody catch that? That we have a standard takeout letter that we'll be using to send to Alliance Bank.
Yeah, it looks like their fees are capped, because they got an example of $3 million loan.
No.
Showing a $22,000.
I think that's a mistake, is you take 3 million times 75%. I think they're thinking of $3 million.
They might
Yeah.
have, I saw that too, but I do think it's a
It looks
typo.
like a
Yeah.
typo, because it's 75%.
So that's not right, so it's always gonna be.
Yeah, assume it's a 1% fee.
Okay, is there a number, a limited draws? Like, did you have 5 draws or 10 draws? There's a fee per draw, but.
Yeah, there's really not. They're gonna go off an AIA schedule. For those of you that have done that
So do
before,
line
that's what's
items?
called a line item. And, they're gonna look at, the builder is gonna submit a line item request every time they want to draw, and it's gonna say we're 75% done with the framing. We are, 100% done with the footings. So they'll request a dollar amount. Then what happens is Alliance Bank will send out an inspector to look at it. Every time they do that, they're gonna charge $300. Okay, so you can do that. Usually it's done every month at a maximum. Some builders understand that, their cash flow is good and they don't need a draw every single month, so they may do it 4, 5, 6 times during the loan process. But you could do it every month if you want to. Now, if you're building a really big house that takes 18 months to build, that gets pretty pricey. Okay, yes.
I would just like to add a little comment. If we're doing the takeout loan, not back to the iffy borrower, that makes sense. But don't not pose a scenario to them, because the one that I have, with them now, I have 3 borrowers. They have $4 million in assets. There 2 borrowers are Stella. The third one, which I showed you the credit report, had a pre-foreclosure from his son. And I said we could pull him out, and they said nope, keep him in. We love him because it's a fix and flip. They did the whole loan on a purchase with a $120,000 reno, and it's investment property. They're going to flip it right after. They actually like it. They won't do that owner off, but in that scenario, so don't. If you've got a weird scenario and it's a one-time close, don't not pose it to them, because the assets are strong and the loan looks good. They
But
like
the point is, they may want to do it, but
Yeah.
we don't have a loan to pay them off at the end.
right.
And, typically, if they're gonna want to do it,
Yeah.
we're gonna be able to find a loan for them. But I use like a clean slate scenario, because really, if you have a jumbo borrower that's 6 months out of a BK, or out of a foreclosure, and we could do a clean slate for them today, I can't guarantee that we're gonna be able to do that 12 months from now, okay? Because they may pull that off the shelf, okay? Yes?
Is there anything that ties them to us for the takeout, so they don't go shopping us at the end? Or?
There's really not.
Your service.
Yeah, you're gonna have to stay in touch with them and, really sell the fact that, hey, I'm helping you get this construction loan, so you're committed to it.
The other thing Mike, Brian, we do have extended locks. Grant how long they'll go up to 360 days. You'll pay through, but we do. You can sell it at. Oh yeah, with 2 times. We do also have extended locks.
What are the DTI and FICO requirements and stuff?
They kind of follow what we do. In some cases, they'll do stuff that we couldn't even get done out there. Like, these guys underwrite with more common sense than what some of our investors do from time to time, because they're bankers and that's what they look at. So, if you had somebody that was a asset depletion type loan, yeah, they would probably like that loan, because they look at it as an opportunity maybe to bank a really good borrower. But yeah, I would say in general, look at your normal, 36 over 45 type ratios.
Are we gonna need to do the takeout, or are we gonna
suggestion would be is if you don't have the takeout at the end, you're still gonna, so just go as far as you need to go to know you have a takeout. Because it's gonna kind of your problem too at the end when these people have a construction loan and know what to take it out.
Who signs off on the takeout letter? Is it
You do.
management or the LO? The manager?
Joe's gonna sign off on all of it. No, that's a good point that we didn't even chat about, but I would say use your branch manager. And, you know, if the branch manager is comfortable with it, then you're fine.
And so I also talked to Pat about that. She suggests that we do a credit approval, so you don't have to have the title, you don't have to have the appraisal done. You do a credit approval, and that should be done.
And that would be my recommended best practice, regardless of whether they require it or not. There's too much risk. I mean, you gotta have a takeout. This is where it gets ugly, is if you're at the end of the construction loan, there's no takeout, and it's our fault for them never being able to qualify to begin. So guys, just take that extra step and make sure that they are qualified to all borrow.
Okay, so that's the rule, is you gotta get a credit approval on it. And work with your branch manager to have that submitted to underwriting, so underwriting knows what they're looking at. Any other questions on this? Yeah, Roll.
Our caps don't come into play on the commission, 8,000 global cap?
No, it's 50% of whatever the total that we get. I mean, you'd have to have a really big construction loan to get to that level anyway.
But FYI, there's no cap on broker loans, period. That's all, that rule exists for all broker loans, and this is a broker loan, therefore, no, there's no caps.
All right, so half goes to HFG?
Half comes to HFG, and then that gets split.
You get 25 basis points on it.
Yep, exactly.
And hopefully, once it's compiled in the back, that's the goal of doing it this way.
Before I usher in the folks from Washington Federal, now they're not going to be as entertaining as I'm going to tell you that right now, so hang with us, but really it will be helpful. Try to pay attention. This stuff is pretty boring, but you're going to need it down the road. So,
Anybody need to sign in?
Kind of sort of. And with the Lions, they started. I went to them. Yeah, I will tell you one time.
all right, everybody, heads up here. Listen up. Hey, go. I'd like to introduce Robert Volpe. Some of you probably know Robert. He's been doing this a while, and very seasoned guy, done a lot of construction loans, and he's going to start out today, and then I'll let you introduce Lisa when she shows up. And what you're looking at here is the people who have decided to invest their time in learning about construction loans. So these are some of the people that you'll be speaking with. Robert's good about getting back to folks, but because we're such a big group, kind of our promise to the folks over at Washington Federal is that the sales managers will be kind of the first line of defense so that he doesn't get 70 different questions from people. So for those of you, make sure you go to your sales manager first because they'll probably know the answer. But if they don't, then they'll send you this guy's way.
Absolutely.
Okay. So you got some folks on the phone.
Okay.
You're being recorded so that we can train other people in the future.
Okay.
So talk loudly.
Will do.
Okay.
Thank you so much for the invitation to come and speak with you today. Washington Federal is a national bank, and basically we're in mortgages, we're a portfolio lender. And what that means is we keep all our loans. We service about 14 billion currently, and publicly traded, profitable bank, not in any trouble at all. And we've been in mortgages for quite some time, basically 90 years. So we're based in Seattle. We've got branches here in the Phoenix area, about 12, 13. And I work out of the Paradise Valley branch. So I'm in charge of wholesale, and my partner, Lisa Shaw, is on her way. She's stuck on the 101, and she'll be joining us shortly. She'll be the bulk of the presentation, I believe. We have more handouts for you. But in the meantime, what I wanted to basically go over is the structure of the loan itself. It's nothing new. It's just really kind of neat to see it all put in one, construction loan and a permanent loan. So what you're dealing with is a 31-year loan. It is interest only on what you draw on for the first 12 months. If you need longer for the build, we can go out longer. We just need to know up front. Okay? And then when the construction is done, it rolls into a 30-year fixed or an adjustable, whatever one you choose. We are pretty much a fixed rate lender. We've been seeing more and more adjustables coming into the marketplace. We have participated in that too, by offering a convertible, by offering adjustables on a 5-1-arm and a 3-1-arm. So you'll find our rates are going to be very competitive. You should be able to work this market very well. We are getting a lot of inquiries on construction, and the neat thing, sure, absolutely. We're getting a lot of inquiries on construction, so I feel real excited that we're hooked up with homeowners here, because we're going to zero in and try to really service all of you guys that want to really get into and learn about construction. It's an emerging market, and I think Phoenix is going to be just a great area to be in. I'm sure you agree with that. So, in regards to any questions at all? Any questions? Okay. The structure of basically the program itself. When you're in the phase, there's two ways basically. We qualify the first. We can easily do a credit only, and once they get credit approval, then basically with the builder's approval alongside, the program is broken down into where you're approving the borrower as well as you're approving the builders. So where you get into basically the structure of the information in the program itself, you'll see it asks or it answers just about every question you can possibly have. It's really a great tool in front of your borrower to use. What we're going to do is from a wholesale basis is be the upfront person to help you walk through and get qualified, do the disclosures, and then basically we're going to hand it over to like Lisa Shaw, who's going to be able to do the actual inspections, draws, work with the builder, work with the borrower to make sure and hold hands, make sure that over this period of time, everybody's happy. It can be very stressful. The part that I think is very exciting. Losing train of thought here. The part of that's very exciting is the fact that we will work with the builder. We will work with him to help him if he needs credit lines. When we get basically a builder in, we're going to ask for the builder to supply us with financials. Basically, we're going to ask him to give us all of his information like you would a regular loan. So essentially, if he needs support along the way, we can offer him a credit line. We can offer him basically the type of funding where we will fund once a month for 8 draws, 8 inspections, and everything is very closely with the builder to see that he gets paid and the subcontractors get paid. And Lisa basically, and some of the other branch managers will work very closely so that the whole intent is to make it so successful that the builder comes back to you for another construction loan. And we can start a machine by rolling along with other types of construction deals. We're looking for any type of builder. If they can do anywhere from five construction deals or 10 construction deals a year, that's fine. And we'll basically work very closely with them. Any questions so far? Yes.
Robert, do you have a list of approved builders?
We are working on a list, and we will have that put together shortly. This is the early stages of basically introducing this program. We've got an approved list put together. We just don't have it to hand out at this point, but we can help you with a list of builders if you need so. Yes.
Is it okay if the builder's credit, et cetera, is not perfect as long as there's not, a list of judgments that get tagged on?
It's a great question. We're looking for a person that's, or a company that's been able to survive. And we're looking at if there's things on the credit, we really, just like a Bauer, we want to know what happened, what the situation was, and then deal with it accordingly. And how he basically is handled, if he's had a BK or if he's had some type of problem, how he's handled it since that all happened. But we would need a letter of explanation along with his application that he sends over to us.
Understanding that, he had 2 specs in the ground in 08, but he's been clean the last couple of years, it is what it is.
It's a small community,
Right.
and you've got builders out there that are very well known and that have survived. We're going to try to work with the people that give you the trust that the project is going to be done. That's the biggest fear is basically knowing the flow of funds. The construction loan itself is once we set it up and close the loan, it moves into an LIP account at May, and then we disperse the funds and work with the builder, and when he completes something, then we go out and inspect it, and we go into the phase of draw 1, draw 2, draw 3. So we're really hands-on this because we want to make sure that everything is completed, and then we pay for it. We're not going to pay anything up front. So from that aspect, it's really hands-on. It's hands-on with the Bauer as well. So.
I didn't hear you. You do owner builders?
We do not do owner builders.
Okay, what if the owner is licensed general? So right here, builder own. Yes is the answer. That's wrong.
Yes is the answer, but you're going to have to be really convincing that it's not a spec.
Right. We do have a commercial department that would basically do and consider spec construction. And if you've got something that is a project that you want to show us, I can refer you to that department. They just started to do some projects on that. So I think as the market loosens up, you'll see more availability to that. But wholesale right now is not doing construction, it will be the commercial side. And we can work with you if you've got commercial loans, and we can work with you on those situations. We're looking for size, we're looking for large commitments on that. Okay. How do we, let's see here, as we go through and look at basically the program highlights,
some of this stuff, I
Yes.
could tell people how I think they ought to sell your product.
That would be great.
Okay.
That would be great.
I'm a like. What you're going to see is they put out a weekly rate sheet, and I can forward that to everybody who's in here that I received this week, and then you can ask to be put on that so you can see it. But they really have 3 products that we can do construction-wise, and on here I think it actually mentions a 4th that I'm not sure they're allowing us to do, but there's what's called a 3 and a 5-year call, and what those are is the rates that are fixed for 3 years or 5 years respectively, and then at the end of that 3 or 5 year period, it would convert to a Freddie, I think it's Freddie Mac's rate. It's a rate that's published based on what Freddie Mac's interest rates are, and we can go into that further.
Is that fixed then for the life of the loan, or does that become like a 1 year?
That's for the life of the loan, and then it becomes a fixed rate. So it'll be a 30-year AM at the end of 3 years. On a 3-year call, it would convert to a fixed rate at whatever that formula tells you the rate is, and then it would stay that way for the next 27 years. The loans that we're doing with these guys, you're going to have to charge 2 points, okay? One goes to them, one comes to us, right?
Right.
That's the way we've got it set up. So it's not a cheap loan. What I found, and I think Eric may have talked to some borrowers about this program, is they have a great 30-year fixed product for jumbos. And the reason it's great, nothing's great about 2 points, but the nice thing about it is when you, as you guys know, people are always wanting the 30-year fixed rate. They're well below, or at least the last rate sheet I saw, well below the market for jumbo fixed rates. So even though your borrower has to pay 2 points up front, I think you can sell the 30-year fixed product because rates are going up. I mean, I think we all agree that they're probably going to be higher 12 months from now than they are today. So if you have a borrower that wants a fixed rate, they're going to be a jumbo borrower, I think it's a pretty easy program to sell, even though you have to charge them 2 points up front. So that's how I look at this product, and I think in our world, most of us aren't going to be doing small construction loans. You guys aren't going to want to do the headache of a $150,000 construction loan. You're going to want to do the $500 to $1.2 million type construction loans. And for those of you that have been out there before, it was always hard finding a fixed rate construction loan for those folks. We now have one, and you're going to be out there selling against the community banks that are offering 1 year, 3 year, and 5 year arms. Is pretty much what community banks offer for construction loans. So we have something that they don't. So that's how I suggest you go about selling their product. Okay. Anybody have any comments on? Yeah.
So the convertible is fixed for 3 years at one rate, and then it converts for 27 years at another rate.
Yep.
Index plus margin.
Yep. And then, but they also have a straight fixed rate that you can do for conforming or jumbo, and that's where I think their best product is. Oh, okay.
Can I add something?
Yeah, please.
Okay.
They do.
If you're looking at, just to give you some ideas, and Tim is right, what we're looking for is large loans. We're looking for 3, 4, 5, 600,000. It pays, and the rates will reflect that. The rates are competitive from a jumbo aspect. So look at us as a jumbo player, and we want to stay on the top end of the market because we're going to see a better quality borrower, we're going to see better scores, we're going to see more liquidity, and we're going to see a easier loan to do rather than looking at smaller size loans where you're starting to stretch and you know they don't quite have enough cash, but they've got a lot of equity in their lot, and they're looking to put something up that would need more financing. But to give you an example, we'll go as high as 80% up to 700,000, 75 to 850, and 65 to $1.5 million. Now there's 2 levels on an 80% loan. There's a level of 80s to 600,000. The 30-year fixed would be 4.25. Okay, if you're charging 1, that point basically is your your origination fee, and we basically are charging 1% up to 700,000. And that 1% is capped at 700,000. So, and what that means is that includes all the draws and inspections. Includes all 8 draws, 8 inspections. So that basically is our way of paying ourselves to service the loan. So 80 to 600,000 for a quarter. Mentioned the adjustables. 80s to on basically the 327, and really the convertibles are an old-fashioned type of loan. It's really a fixed rate loan with a teaser rate. I think that's the way to look at it. It's a 30-year AM. It's a 30-year product with a teaser rate of either 3 years or 5 years. And the teaser rate for the first 3 years would be on the 3-year would be 2 5/8. On the 5-year, it would be 3 5/8. So you're fixed on that, and then it rolls over the Fannie Mae 30-day net index, rounded up to the nearest date, and that you'll find basically at the lower bottom of the rate sheet when you go onto the website, plus the margin. The margin basically is usually 0.75%. There is on the adjustables, there's also a 5% life cap. You're going to have just one roll on these convertibles. So there are a lot of people that will do the 5-year, get the cheapest rate possible at 3 5/8, and then look to do something else down the road by either paying off the loan or just rolling with the interest rates as they go higher.
And does that, would you go to a Fannie Mae rate or Freddie Mac?
It's a Fannie Mae.
Okay, so Fannie Mae does it, you get that rate like a month before conversion?
Yes, it would be
And
notified.
it's published in Wall Street Journal?
Yeah, and we publish it daily as well. So today's rate is at 4%, and the margin would be 4 and 3.
So
Would be
1
3
month
quarters.
before it converts, that's when you pick the, that's when you go get that rate.
Yeah, it's they get notified that it's going to roll, and basically yes, it'll be somewhere in between there. I don't know exactly precisely, but it's very close at that period of time. It's like within the 90-day period.
So that plus the margin.
My buddy Lisa Shaw is here.
Sorry. Bad traffic.
She has done so many construction loans, and she brought her little portfolio here. And any question on the rates at all? Yes.
Will you do like a $2 or $2.5 million loan?
You know, we
I mean, it's the PV house. It's not going to be $1 million.
we can stretch slightly above the 1.5 million. I've seen us go like 1.7 or 1.5, but if you stay within the confines of that, it's going to have more success. We're not looking for the super jumbos. We're just looking for basically the middle type of jumbos. Yes.
Did you say your initial draw will pay off or soft costs or not soft costs? No soft costs. Of course, we'll pay off the lot loan if there is one, correct?
Yeah, absolutely.
But no soft costs, no permits.
The first draw is, we can always, when I think about Washington Federal, you can always ask for exceptions, right? So, and you're talking about the larger loans, 1.5, you know, if it makes sense, and they're as good as gold, and it's 50% loan to value or 45% loan to value, when, you know, we'll look at it. The first draw typically is after foundation slab is poured. Okay. But we also do prepaids for credit to the borrower, which we'll talk to as we go into the actual program. So if the client has prepaids that is in the builder's budget, we can give that to them back, and that's part of their closing costs. So we either take it off their closing costs or cash to come in with it.
Deposits and such.
Right. So plans, permits, you know, if that's all paid for ahead of time and it's part of the builder's cost, yes, we'll give that to them back as a prepaid. So, you know, if they have to come in with 40, now they're going to come in with 30. We're going to take that off the top because they've already paid for it. And we're going to talk about that a little bit, how you get the product out there, how you talk about it. I'm Lisa. Sorry I'm late. Careful what you wish for. I left at 9:15. I'm going to be there early. It's all going to be handed out. I have treasures for you, and that didn't happen. So careful what you wish for. Did you talk about the wholesale versus retail, like wholesale, so if you're going to pricing and rates, and I don't know what the wholesale side offers, I handle it from funding on, if you will, for the construction. I babysit the builder, the borrower from thereafter. So to talk about here, to talk about the product with you all, to get you at a comfort level, I guess, to talk with your clients on our all-in-one custom construction, and that's exactly what it is. Their permanent financing is in place when they fund their loan. So their 20% or more that they choose to put down is due at closing. Did you do the bridge?
No.
Okay. So we'll talk about that. So stop me if I cross over in from retail to wholesale.
That's okay.
Okay? And I understand you don't do lot loans, but with this particular product, if your client's buying a lot with the construction loan, and we can get it funded in that 90-day period, which is the rate lock, you can always go past the 90 days, right? But you lose that rate that you locked for the 90 days. You won't lose the deposit. I carry over the deposit. If we don't get it closed in 90 days, it's no fault of the borrower, usually or the bank. It just is what it is. Permits take a long time. But if they're buying a lot at the same time they're building, that we can't do, right?
Right.
Okay. Wholesale just doesn't do the lot loans if they're not building right now, which some retail does, but wholesale doesn't. But if they have a lot that they want to purchase with the construction